Cost. You see, you're recording.
All right. Hey, I have Dr. Cristián Bravo Roman with me. He works for Western University in Ontario. Bravo Roman, could you tell us more about what you do and what that has to do with credit scores?
Okay, well, hello, Esther. First, thank you very much for inviting me to this. Really exciting to get to talk outside of the typical scientific blabber about that and speak about the important things, right? So I am an associate professor and the Canada Research Chair in Banking and Insurance Analytics here in Canada. And my work is in the use of alternative data to improve, hopefully, credit scoring and in a wider view to understand the impact that these new sources of data can have on our on the use of credit scores, right? Considering now the expanse of usage of new data sources, from images to audio to text to social networks to pretty much everything else that's available, and how that shapes something that's important as credit scores, in particular in North America, where they are extensively used for pretty much everything.
Yeah, exactly. They really are used for everything. In our research, we found your paper where you worked with Dr. Oscar's daughter, and it's titled "The Value of Big Data for Credit Scoring." Can you tell us a little bit more about what you looked at in that paper, such as like using the phone data, or and like what
Sure.
country the study was from?
Yeah, so that specific analysis was a joint venture between a telecommunications company and a bank. Sorry, but due to NDA reasons, we can't really reveal the specifics of the countries and everything else. But these two companies share data and hire a third party in order to study the impact of those two things, right? So they contacted us to do a proper validation of that. And Dr. Oscar's daughter was the leader of that project. So I'm sure that if you speak to her, she'll tell you a lot more about that, but I can certainly speak about the implications of this study. So this study was focused mostly on the analysis of how connections between people allow risk to propagate according to the network. So basically, for example, if you're working in the same company and you suffer a shock can be you getting fired, for example, right? That probably means that there is a depression at all of the other members in your company, and you probably call them or text them or whatever, right? So the question is, can that be used to understand how risk will evolve across time, right? And how it will affect other people. And no one had ever studied this before. No one had ever understood the relationships between how the people you know are precursors to potential shocks to you, right? No one is saying that or it wasn't our original hypothesis. I'm going to speak a little bit more about that later if you want, but we never thought that just because someone had failed that you were connected to, that immediately meant that you were a worse payer. But what we thought was that the risk that we were seeing around you, in your surroundings, right? If everyone is at risk around you, it's not crazy to think that you are also at a higher risk, right? That was the hypothesis that we had. And phone connections are a great way to measure that. This is extremely potentially damaging data if used incorrectly. And I think that it was a great thing that we as a university researchers actually were the first ones to tackle this problem, because, well, we have ethics panels, right? And we're doing this to understand the impact of that. And if you read the paper is neither an apology nor a critique of that. Is saying, look, this data is out there. This data can be used like that. Here is some light on the impact that can have. And we measure it So if during our research, we discovered that there is economic value on this, there is an incentive for companies to use this data. And they are not going to get the same level of scrutiny that we have. So we understood that there was a major risk of doing this from a point of view of what could happen. Because of course, why should you be blamed about the increased risk around you?
Yeah, exactly.
Right? And that's the danger here. And in fact, that's one of the core conclusions of this. So afterwards, we realized that this information was really, really, really useful, particularly in what we call thin file borrowers. So borrowers where you don't really know anything about. Think about the 20-something-year-old fresh out of uni, first job, right?
Yeah.
You don't really understand anything about those potential borrowers. So banks have always tried to grasp at anything that they can in order to increase their understanding of that. And in fact, we published recently a preprint with a much, much more in-depth analysis of that. And even though once they have history about you, once a financial institution knows you, once you have a proper credit score, then that's going to trump all of this extra information. This incentive to use the data is relevant to make a decision at the beginning of your credit history. And that comes with a whole bunch of questions. The main question is here is, well, what are the equality of access and potentially bias impact that this has?
Exactly.
And the results that we saw imply that this data can certainly exacerbate potential structural differences between these groups. So, for example, if you come from a more depressed area, then there is going to be higher risk around you.
So if you're living in poverty, you're more likely to be associated with risk. Is that what you mean?
Exactly.
That
right?
Implications, yeah.
Exactly. So this data, and this is a final recommendation that we make in the paper, this data should not be used for discriminatory, potentially negative purposes. So the solution that we came, given the economic incentives, is that if this is not going to be strictly forbidden, like you're right now in Norway, in Europe, we found out during our study that this probably could not be ever get off the ground because both banking data and cell phone data is considered of the highest level of privacy in Europe. That is not the case in America.
What about Canada?
Right? Canada is somewhere in between. I think that it could be done, right? I think that it could be done, but you gotta be a bit more careful. But in the US, this is certainly something that could be used, and I think there are a few services out there that use something similar. But our recommendation was that this should never be used in a negative way, and B, this should never be used in an environment in which giving a loan to someone means depriving of someone else of a loan. You see? So in a bank creates its own money. So when you give a good borrower a loan, you are having a very minor impact in your capacity to give new loans, especially if this borrower is actually consistently good across time, right? So you will not be depriving anyone else of loan. Compare that to a fintech that is not regulated, right? That does not have the capacity to create its own money, where they are backing up the losses with private capital. Maybe given to someone will deprive someone else. And given that you cannot separate this equality impact, right? This inequality impact, our conclusion is that probably in that case, you should not use these sources of data, because you are using your surroundings to make a prediction of what's a potential risk in the future for a person. And that's discriminatory by definition against the person, you see?
Yeah. So let's talk a little bit about like what kind of policy solutions there might be out there. When we talked to Dr. Bassens, he mentioned the Basel Accords in Europe.
Yeah.
Is there anything similar to that in Canada that might protect people from the misuse of data in this way that you were?
Yeah. So there are two things there. So speaking about the Basel Accords, so the Basel Accords are international; they are not just European, right? In America, is the very famous Dodd-Frank Act, right? The one that Trump said that he wanted to do away, right? So the Dodd-Frank Act was Basel III. So there have been three accords, 3.5. Most people refer to the 0.5 like Basel IV, but that was one for like 10 years from now. But as of today, there are three current accords, right? Basel I, II, and III. And Basel III is an international accord that every jurisdiction interprets with little variations that are allowed, right? So all the signatories make an agreement of working towards full implementation, right? But again, every country also adjusts to its own reality. So in the case of the Basel Accords, Europe has the full Basel Accords implemented as they were written, right? The US has the Dodd-Frank Act, which is the American interpretation that has slight variations, but not that many. And Canada has something closer to the European system, right? But still with some provisions that make it more amenable to American banks, given our close relationship, right? Okay, that said, the Basel Accord imposed for all banks, right, given their importance in creating money in the economy. So that's the thing, is that banks are the engines, the ones that produce and destroy money in an economy. Given the strong power that they are strictly regulated so that they don't destabilize the system given economic incentives. That's pretty much it. Is that if you let them run amok, right? History has shown that when things are good, they just print money. When things are bad, they destroy money and they make crisis worse, right? So the whole point about the Basel Accord is reining in that behavior by aligning the regulation with the incentives so that the behavior is the way that we want it to be, right? Mm-hmm. Stable. Counter-cyclical, we call it, right? So that the thing is flat. When things are good, that they rein in a little bit. When things are bad, that they are incentivized to inject more money in the economy. That's pretty much it. And that is tied to their own risk behavior. If I target extremely risky people, then I need to be safer, right? Then I need to have a bigger back to have the weight on me. If I'm not, then I am going to, right? If I target safer customers, then I can have a little bit more leeway.
Okay, so that's how it connects to creditworthiness. Is it regulates
exactly.
Behavior?
It forces bank to make a very detailed analysis, and that's where credit scores come into play. When you're talking about retail lending, like you and me, credit scores are used in two ways. One is called at the application level, in which when they don't know you, and this is where alternative data, such as the one that we're discussing, really comes into play. And the other one is as you pay the loan, and when we start knowing more about your behavior, so they can fine-tune your risk to see how your first guess evolves in time, given that I know more about you. That's called behavioral scoring. Okay, so what we have seen in all of our research, and as I said, I can point you to this preprint on thin file behavior, blah, blah, blah. We've seen that alternative data and this sort of new data sources are a good predictor for application because we don't know very much about you, but behavior is always king. As we start knowing how you behave, your own behavior is the one that actually helps determine that. But that doesn't do anything to do away with the structural differences that we were talking a little while ago, right? Because those are relevant at the application level, right? A credit bureau does not have your payment history of the loan of your bank. They only know when things go bad.
Oh.
Right? So it gets a little bit tricky in the relation between the credit bureaus, which banks can buy information from and provide information to, right? But every bank should create their own credit scores that align to the target that they are going to. And this is one of the core misconceptions in credit scoring, is that your credit score is one thing. That's not the case. The bureau, the credit bureaus, each one of them calibrates their own credit score given the information that they have available of you. But each bank will calibrate that again, given the target and the risk, where you compare against every other customer that they have.
Oh, right.
Right? So your credit score may be in a bank 700, and in another one 650, and in another one 800.
It's all dependent on the data that they have, right?
Exactly. The data that they have, the target that they have, their own strategy, a whole bunch of things. And that's the whole point of the Basel regulation, the way that they go and measure this in detail. The other important thing that it has is that since it's regulated, the credit scores that they use need to be approved by the banking regulator. So in every country, the banking regulator literally sends someone to sit with you and check that all the variables that you're using are right, that your procedures have been correctly controlled, that everything had been done according to a known and as fair as possible process without structural inequalities, right, that they can be detected. So that's why the usage of alternative data is not very strong in banks today, right?
Okay.
However, now let's go to the other aspect, the fintech, private capital. If you're risking your own capital and it's money that is already there, it's your own money, right? Like yours, Esther and me, we get together and we put like $100 on the table, right? And we decide to lend it. We are not going to be regulated, right? So a big fintech company does not necessarily is regulated right now, and that is something that's still pending. And if you read it, the banking regulators are just starting to catch up with that. Remember, regulation is always one step behind society, right?
Yeah.
Because it's reactionary by nature. So we as a society still haven't even decided yet what's the place of this data within the context of the financial system. The trend goes in the direction of that the same regulations that apply to banks should apply to these companies when they have the potential to destabilize the system. Because remember, what's the core of the banking regulation here? They don't want that the creation and destruction of money, so constraining of loans or giving too much, actually destabilizes the country.
Wow.
And we know this can happen. It already happened in China, where many companies started appearing. And the government had to crack down heavily on those companies because they had started to become the primary lenders. People were not going to banks anymore. They were going to these lenders. So they were putting too much money on the table by moving it between provinces that were way richer, right? So you had one that made 4 times less money. So if your company is making well here, you can put more money here, right? And that was enough to destabilize local economies.
Wow. Thank you for all that. Is there anything else you want to say about how alternative data could affect people trying to get credit or build credit before we wrap this up?
Yeah, of course. So the alternative data per se is not let me put it this way. That data is out there, and there are always going to be incentives to use them if it is available. We still are not sure about exactly what alternative data is doing. And it requires a very careful analysis that you are not just reinforcing structural differences such as the one that we have. it can be very useful. So in the example of the one I gave you, if you follow our recommendations, we believe that it will help some people jump faster on the financial system, right? And get further access. If you just use it indiscriminately, you're probably going to make structural differences even harder, right? Even going even further. The important part here is that you understand that this is a risk of using any new source of data, any. And our analysis have shown that no algorithmic system, no, our as a scientific community, this is not my result. Any algorithmic system will always encode some sort of discriminatory behavior that can be damaging to some communities. By using any variable that you can pick. It's never enough just with the algorithm. You need a human oversight.
So that's where the management and policy comes in, right?
Exactly, management, regulation, and we as a society, making the decision as a society to say, well, this is where we draw the line. These are the things that the amount of people that want to use this, right? And this is the amount of transparency, the amount of analysis that we want people to do. Credit scores have existed for many years and they will always be there. There will always be a need for them to exist. The only difference now is that the amount of data that we can use got bigger. So we need to always be careful in understanding how that data is representing behavior and not an identity. This is what I tell all of my students always. Your models should always measure behavior of the person, never identity, never. However, why do you speak about that? You should never discriminate in any sort of identity behavior. You should always allow people the chance to change or improve, right? So behavior is what we want to measure. And it's very difficult with these new sources of data to separate it, but we need to do the effort. And that's what we're all working for, the ones that are researching on this.
I think that's a really good takeaway to have. I guess I thought of one more question for you while we were talking, if you have time for it.
Of course, shoot.
Yeah. You mentioned that there's banking regulators that make sure everything's working according to the laws. Do those regulators ever get input from you and your colleagues as scientists on like?
Yeah, so I am personally advisor to my home country's regulator, right? To one area in particular, to one part of them, to the area of financial inclusion. And I work with them in financial inclusion and how fintech and technologies can help bring more people into this. And but again, this is only as strong as the need within the countries, right? So I think that there is a dialogue between many countries and the regulators. And I think my conversations with the regulators is that they want to do the right thing, but they are constrained by the laws, and the laws are slow, right? Think about how long it takes to pass different privacy laws in different places, or think about how the US works, in which privacy is a state matter, it's not a federal matter.
Yeah.
Right? So if you're in California or you're in New York or you're in Texas, in those three places, you're going to have completely different privacy laws, right? Mm-hmm. And with different levels of complexity. So I think that there is contact, but it is very local and it varies in intensity and between countries, between territories, between different places. Sometimes it's pushed. So I've been advising banks in developing countries, and some of them are only worrying about this because they are doing international businesses. And when you're doing international banking, then you need to worry about these laws. These laws locally are not very strong, right? But then they jump internationally, and that forces them to go, and it's kind of a big shock. So I think that they want to do what's best. That has been my impression. But what's best, as I've said, we have no idea. There are many great people working in understanding where should society feel on this. And if you ask 20 people, you're going to get 30 opinions. We haven't decided yet. And I think that the answer is going to be something. So it's going to be something maybe local, maybe not. I don't know, maybe evolving, probably like every complex thing. But we're in a brave new world in that aspect. And we're in a world in which we're not understanding yet the consequences of using certain things and how we are ingraining everything that society represents, right? So yeah, they are, but who knows where we're going to land, and regulation always moves way slower than technological progress.
Yeah, and then there's science in there too. So
oh yeah, of course. And what we're doing is that, right? So my own research is that. My own research is finding these opportunities to study the impact of new data and to study it from a scientific point of view, right? To shed light. So I kind of like to think that my research is that, right? Understanding the impact of that. Let me give you an example. Another paper I did in microcredit used text, right? And what we found out was that management gave a lot of importance to the text evaluation that they did about these micro entrepreneurs, many of them with no knowledge of accounting. So they interviewed them in depth and tell them like, okay, explain to me what's your business idea? Why do you think you should get the loan? And blah, blah, blah. And they wrote this very little text. We ran a statistical analysis on that, and we realized that basically everyone just rehashed the data that they were already collecting numerically and that could be reflected by a traditionally tweaked credit score, right? So like using, of course, one tailored to microcredit, but still, the interview that multiplied by like 2 or 3 the cost of these loans, because you need to send someone, sit someone with them for like an hour, was only increasing costs for no statistical benefit. Right? So the answer was either you train your personnel better so they are actually doing what you want them to do, right? And our analysis of the text actually gave us some hints on what they should be asking. Or you do away with this and just lower your prices, right? And become more competitive. And whichever one of the two, so that's, they had a lot of trust from management of that. It gave them confidence that the numbers were true, right? So for them, it was this verification step. It was like, yeah, this professional person actually is verifying that things are working. But in reality, what they were doing was just increasing the cost. And that means leaving away a whole bunch of businesses that could not afford that cost. You see? So yeah, that's pretty much where I think we're going with this.
Yeah, that does sound like a challenge of we need management, but is it giving us the benefit that we need and can
exactly
afford it? Yeah.
So it's management, society, regulation, consumers. This is a societal wide issue, and I think it's great that you're thinking this from a social sciences point of view, because it's correct. It has a major impact in the way we live our day-to-day lives.
Yes, thank you so much for talking with me.
It's been a pleasure.
Dr. Bravo, it's been great hearing your ideas, and I look forward to working with you more.
Okay, my pleasure. Thank you very much for the invitation again.